Ladies and gentlemen, I'm delighted to welcome you today to our webcast titled Building an Allocation in Private Infrastructure. My name is Christoph Sietz and I'm the founder and CEO of Patrimonium. In light of geopolitical uncertainties and significant economic volatility, many investors are looking for robust long-term opportunities. In this context, we would like to show you today how private infrastructure can contribute to the stabilization of a portfolio. Today's agenda is as follows. I will say a couple of words about Patrimonium in general and Patrimonium infrastructure, and then hand over to Jan-Ulrich Salchow from Ecofin. We are very delighted that he has agreed to share his views on infrastructure asset class with us today. Finally, Binja Berchtold and Cornelio Delan from our infrastructure investment team will tell you more about our approach and its performance. This will be followed by a Q&A session for which you can submit your questions online at any time during this presentation. I would like now to briefly introduce the three speakers. Jan-Ulrich Salchow has been with Ecofin Investment Consulting AG since 2016 and he's primarily responsible for the selection and monitoring of asset managers. His analytical focus is on actively managed strategies, particularly alternative investments, including private infrastructure. Before joining Ecofin, Jan worked at the Max Planck Foundation in Munich as an investment manager responsible for hedge funds and equity strategies. Prior to that, he spent over 10 years at UBS in Zurich and Hamburg. At UBS Asset Management, he worked for several years as a hedge fund analyst. Binja Berchtold is responsible at Patrimonium for transaction execution and portfolio management in private infrastructure. She has over 15 years of professional experience in sustainable infrastructure investments in private and public markets. Prior to joining Patrimonium in 2020, Binja worked in investment management at the Private Markets Boutique, specializing in impact investing. Previously, Binja was an investment manager at EIC Partners and energy infrastructure-focused investment firm. Cornelio Delan has over 15 years of experience in private markets investments. Before joining Patrimonium, he was partner and responsible for investments at EBG Investment Solutions AG, a Zurich-based private markets boutique, focusing on sustainable investments, and investment manager at LGT Capital Partners, a leading global specialist in alternative investing. On the next slide, you have an overview of Patrimonium. We manage today over 5 billion in assets in the 4 asset classes: real estate, private debt, private equity, and private infrastructure. We have over 70 investment professionals in our 2 offices in Zurich and Lausanne. Our investment base is mainly institutional investors. About 70% are institutional investors, and we are very proud to have over 180 Swiss pension funds as our clients. If we go to the next slide, it shows a little bit the investment history of our private infrastructure investment class. For me, infrastructure was always a natural extension to real estate. It has the very similar characteristics than real estate, recurring cash flows, hard assets, and actually it's managed quite similarly. So we had the opportunity to start our investments in infrastructure in 2015 with 2 rail car portfolios. I call it also rolling real estate, which have performed very well. Then in 21, we could start our first climate infrastructure opportunity fund, which has also performed very well since then. Today, we have two products open. The one is also a Luxembourg-based RIFE, Sustainable Climate Infrastructure Opportunity Fund 2. And the second one is especially made for Swiss Pension Fund. It's in our investment group of our foundation, and it's in a structure of an evergreen. So this is the overview, but now I would like to hand over to Jan-Ulrich Salchow for his presentation. Thanks a lot.
So thank you very much for having me here. So, no, that's it. Do you see the presentation? I guess so. Very good. So thank you very much for having me. I will now look at the asset class of private infrastructure from a consultant perspective. And to do that, the idea is to go a bit alongside the investment process. So in the first place, to look at what infrastructure actually is and the investment case of infrastructure, then further move on to historical returns, but also expected return and risk, and the behavior in an ALM context and a portfolio context and scenarios. And then as a final step, to look at the implementation of the asset class. So how can you get access to private infrastructure? What's important when you do manager selection and the investment planning? Obviously, I mean, in the time we have, we can't go into every of those points in real depth, but we will come across the most important points from our view. So to start with, we would like to share a view on the asset class itself and go a bit into the investment case. To start with, you can see here two of the pension fund studies, one from Swisscanto and the second one from UBS, and then the figures of how the allocation has evolved over time. And as you can see, just 10 years ago, infrastructure was nowhere. It was way below 1% and totally meaningless to the overall performance and portfolio construction. But what we have seen since then is really rapid growth over those years. And now the latest figure, and UBS is a bit more up to date on that, is that we're at around 2.2% of the overall assets of Swiss pension funds. Obviously, 2.2% is still a very low allocation, but I mean, if you look at the details, then it's really that a lot of investors have no allocation, and then those ones that are invested have typically larger allocations than just 2%. And obviously, given that many investors have just started the last few years, they are still in a build-up process of the allocation, which typically takes a bit of time. If we put this into a global context, Switzerland is not alone. The asset class generally is evolving and gaining more attention. If you look at the left-hand side chart from Preqin, I mean, the capital raised and the capital invested has increased the last 10, 15 years significantly. On the right-hand side, you can see how much is invested. It's not 100% up to date, so going just until 2021. But it shows a very clear trend. And this is really a global trend that has evolved over that period of time. From our perspective, I think there are some points contributing to that. One is the demand for capital of the asset class, but I think a very important point to push this forward in the first place was also that the low to negative interest rate environment, everyone was looking for alternatives to those assets that did not return much anymore. And infrastructure was offering a very compelling case in terms of stability and
Jan,
expected
I'm
returns.
sorry to interrupt you. I think you are sharing the wrong screen. we always see 2 slides. Maybe you can
Okay.
change that a bit. Sorry.
And then let's see if we share the right one. Now it should be better.
Yes.
Good. But the right screen was always on. You have just seen the next one also, which you shouldn't. So with that, we are coming to the slide you have already seen. The investment case itself, and I know most of you probably know the studies from World Bank, but also from other sources like McKinsey and other supranational organizations. I mean, given climate change, given the bad shape of existing infrastructure, given AI and the need for data centers, etc. I mean, there's a huge demand for investments into the asset class over the next, not just few years, but more or less decades. The funding gap is quite substantial. Governments are often heavily indebted and need also private capital to fill this funding gap. And I mean, from our perspective, this should lead to continuously attractive returns in the asset class, because there's, I mean, not enough capital to really fill the funding gap. So the pricing should remain attractive. Now, I think that's a very important point in that context. That's the definition of infrastructure. And I think it's very important to know how it's defined. And then also, if you invest, to make sure that you truly invest into infrastructure assets that, I mean, show those characteristics. Most of them are known. It should be a real asset. It must be a real asset. It must be absolutely necessary for the functioning of a region or country. That's another point that's very important. In terms of characteristics, typically infrastructure has very low demand elasticity, because, I mean, you need water, you need power, you need transportation, all those things. So you can't just say, I don't need it anymore, and I save the money, which then also means that the asset class is relatively resilient in economic downturns and over time. Then further on, typically infrastructure is quite monopolistic, so you don't have water supply from a number of firms, but just typically from one, which then also contributes to the stability. So that leads also to very high barriers to entry. And those high barriers to entry on one side come from the monopolistic market structure, but then also from the high upfront investment that you have to make to build the infrastructure. What's then typical for those assets is that after the high upfront costs, you have typically low operating costs and relatively stable and predictable cash flows, and then also distributions back to the investor, which is obviously, if you're a pension fund, you need those distributions typically, and is very beneficial. In addition to the real asset character, typically the revenues are also linked to inflation. This can be contractual, this can be from a regulatory standpoint, which then gives you a good protection against inflation in all of its forms. And the final point, I think that's very important from another perspective. As the goods and services you're delivering are needed by the public, typically you have a lot of attention. And I think this calls for a very humble and prudent approach, and not extremely high returns by overcharging, because then you get into focus of the regulator, and you will probably have lower returns than expected in those cases. On the lower part of the page, you can see the different sectors you have in infrastructure, and then typical assets within those. Now coming to the investment case, we spoke a lot about the strengths and opportunities. Obviously, every asset class also has its weaknesses and risks. Many of those risks are, widely known for this asset class. So especially the political and regulatory risks, which are very important. Market risk is maybe a little less of a concern. Technical risks are obviously there. If the technology changes, your assets might become obsolete. If you're more on the greenfield side and you develop projects, then obviously you have project risk. And in portfolio construction, obviously, the illiquid nature of the asset class, and regardless of how you invest, whether it's an evergreen fund or a closed-ended fund, at the end, the underlying assets are illiquid, and you need to treat it like an illiquid investment. And infrastructure assets are also very long-term. If you commit to a typical closed-ended fund, then you can expect to have most of the money back after 15 years, which is a very long period of time. As for all kind of investments where you invest into corporate structures, leverage is always a topic, less so on a fund level, more so on the underlying company level. So within the due diligence process, I think this should always be an area of focus. And you need to take care of it to make sure you don't have overly high leverage. Then also contributing to the investment case, obviously this is an active asset class, demands a lot of work from and expertise and experience on the side of the managers. So it comes with also higher fees, but obviously not as high as for like private equity or hedge funds. And then a final point, I think that's probably also clear for most of us. I think it's obvious that over the many years of very low interest rates, this has driven up asset prices across the board. Bonds, equities, real estate, art, crypto, whatever. And obviously this also had an impact on private infrastructure. But if you look at the discount rates of those assets and their valuation process, those are typically still in a very good range, and so the pricing should be okay. With that, I would like to move on to the next part of today's session, which is about the expected historical returns, expected returns, and the ALM context. So what you can see here on the next slide, on the left-hand side, on the upper part, is, I would say, those are like the typical return expectations that you have for infrastructure. And those are not, the numbers that are given here, they are not adjusted for the current environment. They are like more or less the long-term expectations. So they might fluctuate a bit within those ranges, but I think those ranges are still very valid. And as you can see, as for every other asset class and relatively similar to real estate, depending on the risk you take, obviously the return varies and also comes from different sources. Another dimension which you have to look at in the context of returns is the contractual nature of cash flows. And there you have like regulated cash flows, contracted, and GDP sensitive. And obviously those different kind of cash flows, contractual natures, offer different, stability across the investment cycle, the business cycle. So if you look at the asset class and you do diligence on managers, you always need to be aware of how you're positioned here. Now that's, I think, always a very interesting part and something people always want to know, how have historically returns looked like. For infrastructure, you see that we have a lot of different indices to measure performance. There are indices that measure the performance of illiquid closed-ended funds. Then on the underlying assets, the second group, and the third group is on listed infrastructure stocks. What you can see here is that especially for the funds and assets, the returns have been extremely attractive in the past. Obviously, those were the early years of the asset class, so probably the returns come down a little from that level, but obviously depending on many other factors as well. But they have been extremely attractive. So even if they are a little lower, they are still very attractive. The listed infrastructure equities, those returns have been a bit lower. Whatever the reasons are, I think there are a number of potential reasons. They are liquid, for example. The alignment of interest is maybe not as good as for funds and assets, etc. And then the final point here on this page is the graph you see on the upper right-hand side. It shows some of those indices, just a selection of those, and some of the evergreen funds that have a long track record. And I think this gives a pretty good range of potential outcomes and behavior across, I mean, a number of cycles and different economic environments and crises, etc. And I mean, if you look at that and go, for example, back to the global financial crisis, I mean, in those periods, you will see a dip typically because there's some positive correlation to the business cycle left. Now coming to the experiences of Swiss pension funds. This is also from the UBS pension fund study. As I mentioned, it's a relatively new asset class to pension funds. If you look at the returns on the right-hand side, they are so far have always been positive. So I think that was a positive experience for investors. They are still positive in Swiss franc, which is also good. And I think the highlight of those is that in 2022, when we have seen the inflationary shock and the rise in interest rates, infrastructure still has performed positively and was even the best asset class as per the study. So I think it's showing the value of this asset class in a portfolio context. And given that it's not very heavily used, I think there's a lot of potential to increase the efficiency of portfolios of Swiss pension funds. Good. So now we are turning our view forward into the future. At Ecofin, obviously, we do a lot of ALM studies, and for that we have different scenarios. So we use the scenarios and, if wanted, also stress tests, so more extreme scenarios to test portfolios. Obviously, those scenarios, I mean, you have like the basic scenarios that you can always use. We modify them a bit to the current environment to then have a good set where we test portfolios. And then we come up with expected returns and given the scenarios, also correlations for those asset classes. And now if you look at infrastructure, I think it's in line more or less with what you have seen historically. Typically, consultants don't have like very aggressive assumptions for those asset classes, so they are more on the conservative side. But what we expect for infrastructure is that it performs across cycles and across the different scenarios. So it has a positive returns across those, and also in inflation, which is a quite difficult scenario for some asset classes, it delivers positive performance. So if you include an allocation to private infrastructure into your overall portfolio, typically leads to higher expected returns on one side for your portfolio, but also to a more efficient and less volatile, less drawdown affected portfolio. so much about returns. I think the ALM process and defining the strategic asset allocation typically is one of the first steps you have to go through to be able to implement the asset class. And now we're coming to the implementation itself. Infrastructure somehow, I mean, is a relatively complex asset class. We call this the dimensions of infrastructure. So you have different routes of getting access to an infrastructure. You have different sectors, regions, and the development stage where you enter into a project or into an asset. But then you have further dimensions like the pricing we spoke about, like the asset size, like vintage years, etc. And I mean, unless you have superior timing abilities or you're extremely good in selecting the manager who is the best in the future, our view is you should really diversify across all of those dimensions. And obviously, this also reduces the risk, for example, like political and regulatory risk, because what we've seen in the past is that regardless of which country you go to and how solid it is, etc., and how politically stable, you always have some political and regulatory risk left. And typically, sooner or later, you will suffer some losses or suffer lower returns than expected on a single asset. But as long as you're globally diversified and you're diversified across sectors, I mean, just one asset here and there that underperforms expectations, and with that, it's not really meaningful, and returns are in the range where you expect them to be. Now, that's a very important question. How do I build my allocation to the asset class? There are a lot of different access routes you can choose from. The first one is to go direct into single assets. I think that's just something for those amongst you that have like their own infrastructure team with a lot of experience, and also not just selecting the asset, but also operational experience in that field, which are, I mean, very few in this country and also very few on a global basis. Then the next route would be single funds, where you select a fund yourself and then invest into it. Where we see it in the Swiss context is for the evergreen funds, where a lot of pension funds pick single evergreen structures and use it as an access route to the asset class. And then the next two, co-investment funds and multi-manager, are somehow similar because you use different GPs that manage your assets. One is more concentrated than the other, but I think those two are also good building blocks to build an allocation. If you have enough money to combine approaches, I think that's typically a good and prudent approach. To not to just use one building block, but also to have a part in closed-ended structures and another part in evergreen funds, diversified across managers, and then also using primary and secondary fund investments and direct co-investments in that context. The manager universe for infrastructure is luckily not as large as for private equity or for hedge funds, so we don't speak about thousands of funds, but it's still large enough. So on the single manager side, you have a variety of managers with very different profiles and different, I mean, focus on regions, focus on sectors, or those larger groups that invest across sectors and regions. That's just one side of the coin. Those managers typically have closed-ended funds, and then some of them also nowadays an evergreen structure. And on the other side, on the right-hand side, you can see a number of managers who follow a multi-manager approach into the asset class and offer fund of funds or managed accounts where you can let them manage the money across primary, secondaries, and co-investments. To find the right manager for you or the right managers, I think it's always important to have a manager selection process. It needs to be systematic. You need to have clear and good reasons why you select one manager over the other. And then once you have selected a manager, as this is an active asset class, you should also monitor those managers. And with monitoring, we don't just mean you define a benchmark and you compare returns against the benchmark, but you should really have a look at what those managers are doing in their portfolio, how they are positioned, what they do, which assets do they buy, which assets do they sell, how is the leverage evolving, how are the discount rates evolving, etc., to be really up to date and to build a clear view on those managers and whether you're happy with their performance. Now a few words on portfolio construction, but I will keep this relatively short. One way to get access to the asset class are closed-ended funds. In those, as you know, you have typically a J-curve of investing, so you're committing capital, the capital is drawn, and you see the first reinvestments and later distributions, and then one day the portfolio is turning cash flow positive and returning capital over time. What this means is you need to invest also over time and continue to commit to new closed-ended funds. So you should basically every vintage add further investments to your portfolio to then ramp up the allocation over what we say more or less a few years, and then keep it at the level where you want it to be. I think what's important is to make this planning when you do your first investment, to define a very clear plan how you want to ramp up and maintain the portfolio, and then from time to time, as you do new commitments, to adjust the plan to reality so that you can really move towards your target allocation. Another point that's important in this context is, as we've seen in 2022, there are times when liquid assets react heavily and lose value quickly. In those times, you might come to the upper end of your target allocation range, or you might even go above it. And I think that's another point you need to take care of before you start to invest. What do you do in those situations? And I mean, the answer is quite clear. You should typically not be forced to sell, but you should just maintain your allocation and then continue to invest over the period, because those are the best vintages when you're in crisis. And I mean, the guidelines or the ranges might take care of that, must take care of that situation. What you often see is a portfolio that looks a little bit like this, where you combine closed-ended funds with open-ended structures. Obviously, open-ended structures are much easier to invest in. You just commit capital once, or you can also increase the capital from time to time. Typically, the capital is drawn within something like 6 to 24 months, relatively quickly. And then you invest it and you don't need to do too much about it. But we still think that combining the two approaches really makes sense, because you enter different parts of the market. And I think this is a more diversified approach to building an allocation. And with that, we are already coming to the wrap-up, the conclusions and recommendations. From our perspective as an investment consultant, we think infrastructure has a compelling investment case. We spoke about a number of points why we think so. I mean, it's a real asset. It has inflation protection, relatively stable cash flows. There's a high demand globally for investments into infrastructure. All of that should be long-term beneficial. Then when you're building an allocation, you should follow a very clear and defined investment process. So, I mean, first of all, define what you want, why you invest in that asset class. Do your ALM, define a strategic asset allocation. And if you have no experience in this asset class, I mean, you might also start with a lower one and then increase over time as you have more experience. And then also have a structured manager selection and monitoring approach to it. Then again, the reminder, follow the definition of classical infrastructure. Don't invest too much outside of it, then might end up in other places like private equity or so. If you want to invest in private equity, invest in private equity, but don't do it within this allocation. Invest broadly diversified, really across regions, sectors, strategies, risk profiles, vintage years, managers, etc. Unless you know more than we do and you can time the market or whatever. And finally, I mean, over time, there are always good opportunities to invest. If you're in a crisis, for example, secondaries are typically mispriced, and you can quickly enter that part and harvest above average returns. And when you build such an allocation, always incorporate those thoughts and make sure you can use those opportunities as they come up. That's it from my side. I would give back to Patrimonium. I don't know who's the next speaker.
Thank you very much, Jan, for your insights, and a warm welcome from my side as well. My name is Binja Berchtold, and I'm part of the investment team at Patrimonium Infrastructure. Over the next 15 minutes, my colleague Ornel de Helan and I will take you through Patrimonium's investment approach in private infrastructure. On the slide, you can see that Patrimonium Infrastructure is built on four cornerstones. First, we are climate conscious. We prioritize assets that actively contribute to decarbonization and deliver long-term impact. Second, we maintain a mid-market focus. This segment offers more attractive valuations and a broader range of deal opportunities, allowing us to identify value where others may not. Third, we emphasize diversification across sectors, geographies, and risk profiles so that our portfolios are resilient under varying market conditions. Looking at the sectors, we cover a broad spectrum from electrification, storage, social infra, communication, and digitalization. In terms of regions, we predominantly invest in developed countries, in Europe, North America, and Australia mainly. Finally, we employ a balanced mix of investment types, combining primaries, secondaries, and co-investments to optimize portfolio resilience and performance. Taken together, these cornerstones enable us to generate attractive risk-adjusted returns while staying aligned with the sustainability objectives of our institutional investors. As mentioned, one key aspect is the market in which we operate. You can see that on this slide. Do you know how many infrastructure transactions have taken place in Europe over the last years? Around 220 in total per year. And how many of those were in the mid-market segment, so transactions valued up to 1 billion euros? There were roughly 200. The remaining 20 were targeted by the mega funds. What does that mean? It means that large-scale deals face significantly more competition, which drives up valuations and leaves less room for structuring and value creation. In fact, nearly 90% of all infrastructure transactions take place in the mid-market. At the same time, however, Fresh capital has continued to flow predominantly into the mega funds, as you can see on the right-hand side of this slide. 33% of fundraising targets originate from large cap funds. For our investors, this dynamic creates an attractive opportunity, and this translates into more attractive risk-return profiles and faster capital deployment as we act in the mid-market. And within the mid-market, manager selection is, in our view, absolutely critical. This is precisely where our hybrid approach, combining fund investments, secondaries, and co-investments, provides a strong advantage. As you can see on the next slide, this is also a key differentiator. So how do we access infrastructure opportunities? Rather than relying on a single route, we deliberately combine three complementary investment types: the primaries, commitments to carefully selected funds, giving us early access to diversified portfolios and to managers with deep sector expertise. Secondaries, where we purchase existing fund stakes. This provides visibility on underlying assets, shorter time to cash yield, and the ability to fine-tune diversification. And co-investments, direct stakes alongside trusted managers, allowing us to participate in attractive single assets at low cost while exercising selectivity and control. By blending these primaries, secondaries, and co-investments, we build portfolios that balance diversification, capital efficiency, and return enhancement. For our investors, this structure means early deployment, reduced J-curve effects, and access to opportunities that would be difficult to capture on a standalone basis. The next part will be presented by my colleague Gornel de Helan. He will present 3 investment examples from our portfolio. Please, Gornel, go ahead.
Yes, thank you, Binja. Thank you all for participating. So we have selected a fund investment that came out of our manager selection process, then a secondary transaction as an example, and lastly, a co-investment. So like Binja says, we carefully select managers, and around 30% of the capital we employ by selecting these funds that then will offer us co-investment rights that we typically participate on a no fee, no carry basis, thus keeping our total cost of ownership comparable for a direct fund. And as an example, we have done early in the cycle of our investments in 2021, we have invested into 2 managers, one of which was 2020 mid-market infrastructure fund based in France with an office also in Germany, that with a size in the mid-market space with around 1.3 billion fund size, and that invested in mid-market infrastructure. It's called ICG. It was the first fund from ICG. ICG was a big manager that decided to bank on a spin-out team from EDF. And we particularly liked this fund as a lot of assets were already in the fund at the time we came in. The team from EDF we had known previously, and we knew that they are very good investors. And plus they were playing in the mid-market where they acquired several companies and helped them grow. Their philosophy was to invest with a downside protection and an operation value creation, and we found this very compelling. Lastly, we liked it also as the return targets were around 13 to 15% and with a healthy cash yield, and that we found very compelling in this crowded market. Also, if we looked at other funds in the mid-market space, this fund stood out as the company. Typically, the funds have like 1% GP commitment, which is fine. But in this particular case, the parent company, that means ICG, decided to invest heavily into this new fund. And they put around 200 million, representing 20%, around 20% of their total commitments into the fund. So we invested at the time in 2021, and fast forward today, this fund has been one of the cornerstones of the Patrimonium Climate Infrastructure Opportunity Fund 1, performing very good, at or slightly above our expectations. They managed very quickly to invest all the money, so around 92% of the money was called. And out of the 8 companies, they already had 3 exits that were successful at around 2 times. And there also our thesis was fulfilled as these 3 exits were done. So there were larger funds, these mega cap funds, that acquired these companies at a significant premium, where we could monetize on the mid-market. The remaining portfolio continues to grow well. We have a company called CVE that is expanded, that has around 900 megawatts of capacity. Then we have an EV charging company called Z-Plug operating in France that has, since we invested, become the #1 player in their subsector, and now is continuing the expansion by going into Germany and other European countries. And then finally, there a company called British Solar Renewables that recently have secured 280 million pounds in financing new solar installations of around 500 megawatts. So overall, if we look at the fund, we have nothing to say. It's tracking with a gross IRR of around 20% and the net IRR around 15%. And if you look at the peer groups among funds into this vintage, this is a top decile fund as shown by Preqin. And also making the point, like Jan Ulrich said, so fund selection, even if the market is not as big as in private equity, where you have thousands of funds, in the mid-market space, in infrastructure, you still have hundreds of funds, and fund selection, proper fund selection can make a difference. So we selected 3 funds, all are performing well. It's a tedious process where sometimes you follow a fund or a manager for years and have many discussions, and it's also a relationship as we manage then to get our co-investments and try to co-invest in some of their best deals. So that would be a fund example. Now, if we move on the second type of investment that we do, that's secondary transactions. So for this one, we in our first fund, we have done 3 secondary transactions, and we have chosen for this webcast one in the digital space that we have done. So as Jan said, digital is a growing sector. There's a lot of demand. There are lots of opportunities that you can see. So a lot of managers that want to do data centers and come to us, show us co-investment opportunities in data centers. So we looked at a lot of data centers, but we couldn't get quite comfortable on the infrastructure characteristics, because data centers can be real estate, they can be private equity, or they can be infrastructure investments. But typically also the prices that you have to pay assume a lot of growth and a lot of success, and we didn't feel comfortable. So when we saw this particular project, it's a derivative to the data center growth market in Europe. It's a company that provides fiber solutions to the data centers. So basically they have like 73,000 kilometers, you can imagine, of fiber connecting around 550 data centers in Europe. And given the infrastructure characteristics, it's an oligopoly situation. So there are only 3 players in Europe. You provide them the connectivity. For a data center, it's basically something critical that needs to work. Without fiber, no access to their data. So it's a very nice situation where you grow together, you grow with the market. So the data center market grows like 20% a year in Europe. If you participate in this fiber provider, you are in a situation that you will grow with them. The company was with a large US manager who developed it for 5 years and then offered a continuation vehicle, which puts it in a secondary angle. The valuation was a little bit lower than in the data center, also assuming a certain growth, but much more interesting than investing in data centers. And plus the valuation, there were a very large cornerstone investors such as APG and PIMCO, who are core types of investors and invested, set the valuation and invested forever, like in this platform. And we participated in it 1.5 years ago. How it has developed since. So last year it was a very good year. To the 40 data centers were added. Revenues grew around 10%. The margins when we entered were at 43%. Now they approach the 50% mark. And yeah, so far so good. We will stay in for the next 5 to 6 years, and we expect an ultimate return of low double-digit net to our investors. So this is our secondary transaction. And finally, a co-investment. This co-investment we have done in our Evergreen platform in the Ast Infra. It has been done with a manager that we know very well. He's called Equitix, with whom we had already done a co-investment, as also a manager selection process. What we liked about this, we wanted to invest in renewable energy in Germany, but returns in renewable energy in Germany are a little bit below our targets, and we found this co-investment opportunity. And what it is a decarbonization platform. It's a portfolio of 60,000 rooftop solar and EV charging stations that are all installed in private household leases in Germany. The projects had been developed by a company called Enpal, who is the #1 residential energy provider of Germany. And they decided to move the platform, these assets into a SPV together with Equitix and open it up to a very limited number of co-investors. We liked the whole cash flow, so the portfolio was operational, that eliminated construction risks, revenues. There were 20-year fixed lease contracts with German homeowners. There is a win-win situation as the residential homeowner saves on energy bills while the SPV can earn stable contracted cash flows. And plus the company Enpal had already built a very good brand, so they will take care of the portfolio. And we were very confident that they will remain in the market. So we underwrote an attractive net IRR of 7% and a double-digit lifetime cash yield, which is a couple of 100 pips above your typical renewable energy project you can do in Germany. And since then, the story has been very positive. So the portfolio has performed in line with expectations. There was even lower churn in customers that we predicted in our financial models. Customers remain sticky, the dividend has been paid, and this is an investment that has a remaining lifetime, I think, of 15 or 16 years. So for our evergreen product, for our investors, we can give them low double-digit yields for the next 15 years with this. Thank you. So these would be the 3 investments that I wanted to present, and I give back to Binia.
Thank you very much, Cornel. So when we ask ourselves, what does this approach really deliver for institutional investors, 4 clear advantages stand out, and we've already seen them come to life in the case studies. First, sustainability is embedded at the core. Take the German residential portfolio of the PV solar batteries and EV chargers. These assets are not only profitable, delivering the 8% IRR, as Cornel mentioned, and the 9% yield. They also directly advance the energy transition and household decarbonization. That's sustainability with measurable impact, and it's what regulators and beneficiaries alike increasingly expect from pension funds and qualified investors. Second, capital gets to work quickly. In the European Mid-Market Equity Fund we discussed, deployment was achieved rapidly across renewables, smart mobility, and digital infrastructure. Because the mid-market is rich in deal flow and less competitive than large-cap infrastructure, capital isn't stuck on the sidelines. It's put to work in a timely manner, generating returns sooner. Then third, early value appreciation. The European data center connectivity platform is a good example here. By investing into a critical digital backbone with clear growth prospects connecting over 500 data centers, value creation is visible early on, in particular in secondary transaction. Demand growth in digital infrastructure means revenues can expand rapidly, translating into both cash yield and long-term appreciation. And finally, lower total costs. This is where our combination of primary, secondaries, and co-investments makes a difference. In the co-investments we pursue, such as the German PV portfolio, fees are minimized, typically no fee, no carry, while investors still access high-quality assets. This keeps the overall cost structure lean compared to a pure fund-of-fund approach. So when we connect the dots, the advantages are not abstract concepts, they are reflected in the real portfolios we've shown you. And together, they amount to what investors value most. It's dependable cash flows today, growth for tomorrow, and a structure that remains efficient and sustainable. We've seen the key advantages of our approach. The next logical question is, how do you, as institutional investors, actually capture these benefits in practice? That brings us to the next slide. At Patrimonium, we recognize that no 2 investors are alike. Some want a diversified evergreen allocation that steadily compounds. Others prefer closed-end strategies with a defined horizon, and larger institutions may want something tailored entirely to their own portfolio. That's why we offer 3 complementary solutions. For pension funds seeking simplicity and liquidity, there's our Swiss Investment Foundation. It's an open-end evergreen structure with a low entry threshold of just €500,000. This makes it accessible even for smaller pension funds, while still providing diversification across our mid-market infrastructure portfolio. For those who prefer a defined investment period and a focus on value-add infrastructure, we offer our Luxembourg SICA Frei funds. These are closed-ended vehicles designed for qualified investors starting from €1 million. They provide exposure to targeted strategies with strong return potential and clear timelines. And finally, for the largest and most sophisticated allocators, we create separately managed accounts. These start at 50 million plus and are fully customizable, giving investors control over sector focus, geographies, and investment pace. For some pension funds and qualified investors, this level of tailoring ensures the allocation fits perfectly with their broader portfolio strategy. So whether you are looking for evergreen exposure, a defined closed-end commitment, or a bespoke mandate, the idea is the same. It's flexibility. We meet investors where they are and provide the structure that best supports their long-term goals. To conclude, private infrastructure, particularly in the mid-market, is uniquely positioned to deliver stable returns in volatile times. With a sustainable conscious approach, a hybrid of primary, secondaries, and co-investments, and a proven track record, Patrimonium provides institutional investors with tailored access to essential infrastructure sectors. So that was it from our side. Thank you very much for your attention. We now welcome your questions. Please use the chat feature and we'll address as many as possible. We already have a 4 o'clock, so it took a bit longer. So far, I have one question. With so many transactions happening in the mid-market, how does Patrimonium make sure to identify the most attractive opportunities and avoid the less compelling ones? Cornel, do you want to take maybe this question?
Yes. Yeah, sure. So like, yeah, there are many transactions in the market, and when we started, we thought there is an adverse selection bias, like in private equity. So you invest in a fund, and maybe they give you a couple of investments that are not fitting or they're too big. What we have experienced that we see a lot of transactions. So for every single co-investment that we're doing, we need to filter out like other 19. So there are 5%. And what we do, it's I think on the first pillar, the partner that gives us the co-investment needs to be a true partner. So we see a lot of opportunities that come from GPs that we know less. And we use them also to know the GP better and better. And then we have a preferred list of GPs that we know are extremely serious, that we can work with which we have a common history, like example Equitix or some other GPs where we then tend to take a better look at the opportunities that they show. And plus, we also filter out quickly the transactions that do not fit exactly what we are looking at. So for transactions, we have a very rigorous selection process of screening, initial review, due diligence, and then going to the investment committee. And we try early on to look at the investment that are less fitting for us and focus on the ones that have the best characteristics, that we think have the best characteristics for our products, and then we focus on them. So at any point in time, maybe we have 5 to 6 co-investments that we screen, but just 1 to 2 where we will go and proceed to investment committee. Like this year, it was there were 2 co-investments that made the final round on 50 that we have seen. Yeah.
Thank you. There is another question. From when on do you, on average, expect positive value appreciation? What is your target? Another one, maybe Cornel, you want to take it?
Value appreciation, what is your target? So on the closed end, on the strategies where we have, let's say, a more core plus value add approach, you typically, if you build things, so example, we invested in a very large battery that will be built. So on this one, you put the money to work. So you are cold, and let's say this battery is being built, and for 1.5 years, maybe you are at cost, as the money will be put into the project that has a final date, and then you rely on the quality of the manager, quality of the project team to deliver it in time. And once, let's say in a battery on a renewable energy project, the electron starts to flow, then you expect value appreciation from this day as it moves from a cost item to a DCF item. So typically in value add projects, you have 2 years lag, and then you see a value appreciation further enhanced when you exit it. You have a definite year of 5, 6, 7 years. And then you expect a premium at exit, where the next owner will give you part of your future cash flows as a platform value to acquire it. Then on core assets like the ruler project that we did with the German households, there the value is stable, right? You have a DCF and you have a yield component. and you can see it appreciates from day one in a way. And then we have also investments where you go the structured, so you invest in a preferred equity or a subordinated debt plus a warrant, and there you have also a very limited J curve, where in another investment you see quarter on quarter it goes up step by step. In the funds you have a J curve, and we tend to invest late in the life when we see that the J curve gets minimized and the fund begins to appreciate solidly as you have put the money to work. So that's basically the answer. Net positive value, like on our funds, in the first funds that we started 2021, we had a very small to now J curve. We started to appreciate quickly. Same for the evergreen vehicle, where we have put immediately the money to work, and it immediately started to produce yield. So there again, we had no J curve. Long answer.
I think all said. Nothing to add from my side. So well, I think also there are not no other questions. So many thanks for your participation, and a big thank you also to Jan Salcho for your interesting presentation. We would be very happy to hear from you and answer any remaining questions you may have individually. And yes, now I wish you a pleasant afternoon, and we hope to see you in person sooner or later.
Thank
Bye.
you.
Thank you.
Bye.
Bye-bye.